Hi everyone, Ray here, and it's time for another project management tip. Now, sometimes I get asked questions about how do we fund projects? How are projects paid for? So I'd like to take a little time to answer that today, because as you grow in your careers, it will be helpful to know that. Sometimes the decisions you make about the project may be driven by the type of financing there is. So let's explore that just a little bit. So how are projects paid for? Well, generally by financing the project. Now, the funds that pay for the project can come from operations, for example, any revenues that come in, or they could be capital expenditures, which means that we're typically spending money from the company treasury or the reserves. Now, a third method of funding projects is borrowing, right? Just as you might borrow to buy a house. So you can borrow and then repay money. And in projects, there are a variety of ways to do this borrowing. Now, there can be unsecured or limited recourse financing, which is funds that are made available and secured only by the assets in use by the project and any future revenue stream the project may produce. So the borrower doesn't have to offer up other assets or cash as collateral. And so this is what's referred to as project finance. Now, there are two conventional means of borrowing money for projects. They're debt and equity. Now, with equity, some projects are financed by promises of equity, a conventional type of financing. Investors receive dividends or capital growth proportional to the percentage of their investment. So you've probably seen TV shows like Shark Tank and Dragon's Den, and they've removed some of the mystery of how this type of financing works. Some construction projects may be funded by the contractors themselves or by other investors. For example, approximately 20% of the financing of the Eurotunnel, or the Chunnel, was through equity granted to contractors and private investors. Now, equity investments can be higher risk for investors. First, their distributions can happen only after interest and loan repayments are complete. So for some big projects, this could take years. In addition, there are only returns if the project is successful. So should the project fail, the entire investment could be lost. As a result, investors providing cash in exchange for equity typically demand higher returns than others who are investing in projects. Now, the second type, as I mentioned, is debt. And debt involves the periodic repayment of the investment with interest based on agreed upon schedules. And it's usually done in the form of loans or bonds. Now, debt may be secured by cash or other valuable assets, just like the way your mortgage is secured by your home. With unsecured debt, there is higher risk. If the project fails, the lender or bondholder may not be repaid. Loans and bonds are often referred to as senior debt. This is because the borrower has an obligation to pay off these types of debt ahead of others. Holders of senior debt can also make the first claims on an organization's assets in the event of a project failure. In addition, debt which is secured must be repaid in any circumstances. So if repayment is not possible, the repayment happens when lenders take possession of the cash or assets offered as security. And since unsecured debt carries a higher risk, once again, those providing unsecured debt financing often seek higher rates of return on their investments. Now, there are also many newer unconventional ways to finance projects. But for the purpose of this tip, we're only going to look at two: Countertrade and finance lease. Now, a countertrade is a form of a barter arrangement where goods or services are accepted as full or partial payment in lieu of cash. The recipient then has to sell the goods or make use of the services received, potentially to raise funds for the project. Countertrade is most common and popular for startup projects and international projects involving economically disadvantaged countries. The countertrade is useful when there isn't enough cash to finance the project or if there is an excess of a commodity. There are 4 major types of countertrade transactions as well. There's barter, where the purchased goods are paid for by other goods. Compensation, goods offered in payment are transferred to a third party, and the third party may either be a consumer or seller of those goods. There's buyback, so in exchange for providing an asset, say a factory, that's needed for an expansion project, the provider agrees to purchase or accept a certain amount of the output of that factory as compensation for setting that up. Now, that happens very often when we do business overseas. And then the 4th type of countertrade is counterpurchase. Here, the goods and services acquired are not directly used. Instead, they're sent to a third party for sale. In some cases, an exchange that is both like a countertrade and a counterpurchase can take place. Some of the goods may be used while others may be sent to a third party. Now, the finance leases are those which transfer the risks and rewards of ownership to the lessee. The lessor acquires the asset and provides to the lessee in exchange for a fixed payment over time. In this manner, the lessee frees up cash for purposes such as acquiring a needed asset in exchange for smaller fixed payments. Given that projects are usually temporary in nature, that would make sense to lease any working space needed for a project, which might be a longer-term project or where a facility could be used for operations later. Now, when using forms of countertrade and potentially other forms of financing, it's important to keep an eye on cash flow. While we may not be getting cash in, we still may need to spend cash for our project, and cash is still going to be needed for our operations. So too many countertrades that don't actually convert to cash could be harmful. Now, again, when in your early career as a project manager, knowing how the project has been financed may not be very important. But as you continue your learning journey, these are some additional terms you should know. And when you're in a more senior position, knowing the means of financing may be important to managing and controlling project costs. So thanks again for tuning in for another tip. Be sure to like, share, and subscribe if you like these videos. And I'll see you next week for another tip. Stay well, everyone.